We all work hard for many years to pave our path towards financial freedom. But how do we really know when we're safe to retire without the risk of running out of money? The 4% rule has long been a valuable resource for retirees, but it does come with a few flaws that can leave us broke before our time comes. In this video, we'll dive deeper into the 4% rule to see how it can add value for your retirement planning. We'll also touch on a modern rule of thumb that will lead you to a cozy retirement regardless of market conditions. We'll call this one the stress-free generational wealth rule. If you're new to the channel, welcome. My name's Jeff Teeples, and here we aim to grow your wealth with simple, time-tested solutions. Let's grow. What is the 4% rule? The 4% rule is a guideline that lets retirees know how much of their funds they can extract from their retirement accounts without going broke. Many experts argue that 5% is fine unless something crazy happens in the markets, while others say 3% gets you to where you want to be regardless of what happens. The bottom line is that the 4% rule seeks to provide a steady stream of cash that you can live on when you retire from your job. The 4% rule was created by using historical stock and bond performance with the purpose of lasting for 30 years after someone retires from their job. The math behind this aims to have a person not run out of money for at least 30 years from the day they retire. And we're all going to need a different amount of money stashed away depending on our lifestyle and our circumstances. To calculate the required portfolio size for you to be safe to retire, it's actually an easy formula. You take what you think your yearly expenses will be in retirement times 25. For example, if you think that you'll need $50,000 per year to live in retirement, then you'll need a portfolio size of $1.25 million. That's $50,000 times 25. You can also use the formula that I prefer as a math nerd of $50,000 divided by 0.04 or 4% to get the same result. This is a little more flexible because you can tweak the percentages. The 4% rule was designed to account for most inflation situations. In theory, your portfolio should grow by well over 4% on average to allow you to take a little more as the years go by and inflation increases. Another thing to consider is any income you'll have in retirement from things like Social Security, pension, or other sources. This, of course, will lower the amount you need to save in your portfolio. If you receive $40,000 from a combination of, say, Social Security when you retire and a pension, then you'll need to account for the other $10,000 that you need to live each year. So this will reduce your portfolio requirement to $250,000. That's the extra $10,000 you need to come up with times 25, or 10,000 divided by 0.04. The 4% flaws. The S&P has had a total return of about 11% per year over the last 50 years. So you might be thinking, why only 4%? 11% should give me a lot more leeway than that, right? And the answer to that is, in most cases, if properly invested, that question's exactly right. You would have more than enough. It should last forever in theory. But a terrible market situation, which has happened and it will continue to happen in the future, can drain your portfolio well before that 30 years is up in a worst case scenario. Here are the results when 50-year time periods were tested for the 4% rule. So these tests started in 1926 through 1976. Those were the starting dates, and they ran through 2026, the last 50-year stretch. So there are some projections in here. If you were to withdraw 3% per year, you made it 50 years no matter what. If you were to take out 4% per year, 10 of the 50 years, so 20%, fell short of the 50-year mark. However, they all lasted at least 35 years. If you would do the 5%, then half the portfolios didn't make it the full 50 years, with the worst ones only making it 20 years. And then if you use the 6% withdrawal rate, which I don't think anyone realistically would, only 7 of the 50 lasted the whole 50 years, and 10 of them lasted for fewer than 20 years. You definitely don't want to use 6%. With people living longer and longer than ever before, I would be a lot more comfortable with a solution that never runs out. And we're going to take a look at that later in this video. Income versus expenses. Income and expenses are equally important, and most people with high-paying jobs don't understand just how true this statement really is. When you try to impress everyone around you with your oversized house, your fancy cars, and eating at only the finest restaurants, you're really just screwing up your 4% scenario. Take, for example, someone that makes $75,000 a year and has expenses of $50,000. So they're able to save and invest $25,000 per year. Take another person that makes $300,000 a year but lives the extravagant lifestyle that costs $250K a year to maintain. They get to save and invest $50,000 a year. So you'd think, oh, $50,000 compared to $25,000. The person that makes a lot of money will get to where they need to be twice as fast. Wrong. The high earner will need $6.25 million to begin their 4% rule and maintain their lifestyle, while the lower earner will need $1.25 million. The true secret to success with all this is to invest in your skills and try to earn as much money as possible while doing something you enjoy, hopefully, while reducing your expenses and ignoring the Joneses and just doing the things that make you happy in life. More income and slashing costs are equally important. It's what you do with each extra dollar that's going to ultimately make the difference. Avoid expense ratios and financial advisors. Avoiding unnecessary fees is vital to following the 4% rule. A typical financial advisor will charge a 1% AUM. This is assets under management. The 1% fee will effectively only allow you to withdraw 3% of your funds per year instead of 4%, because 1 is going directly to your financial advisor's pockets. So that's 25% of your money just going poof before anything even starts. And believe it or not, it hurts your overall situation a lot more than 25% over the years because of the compound effect of the money that isn't there. And the double whammy here is that the financial advisor will, generally speaking, be incentivized to put your money into high-cost actively managed mutual funds. These high-cost mutual funds will not only underperform the market over many years, they'll also cost you about another 1% off the top. So now your 4% rule became a 2% rule to have the exact same amount of remaining portfolio each year. Bottom line, and I know this can be difficult, get over your personal connections and fire your financial advisor. Regardless of how good of a person they are, they do not have your best intentions in mind. They will genuinely cost you tens or hundreds of thousands of dollars. In most typical cases, over $1 million. Don't believe me? Let's take a look at an online calculator and see how the 2% fees add up over time. And before we dive in, keep in mind that this calculator will not even account for the fact that 90+% of actively managed mutual funds that your money will be invested in will underperform the market over any 10 or more year stretch of time. This calculator is simply going to show the difference in fees. Reality is a lot worse. This is a mutual fund calculator that's out on the NerdWallet website, and it's a great source to see how much expense ratios add up. So I'm going to break this down into two sections: wealth accumulation during the career and then the retirement years. So we're saying that this person has $0 invested, a 40-year time horizon, fresh out of college, starting their career, and a 2% expense ratio. 1% of that is the assets under management, and the other 1% is the actively managed mutual fund cost. We're going to invest $500 a month, which is $6,000 a year, and assume a 9% return. Unlike the 10 or 11% historical return of the S&P 500, we'll be a little more conservative. Now I already hit calculate, I'll do it again here. So you can see this ending value of this scenario is $2.2 million, but you lost nearly $1 million just to 2% expense ratio. That's that compound effect of what's not there, not what you actually paid nominal dollars out the door. So the ending balance is $1.28 million. Now for part two, I set the initial investment amount to $1.28 million, and that's the ending amount of what we invested over our career. The time horizon is 30 years. We're going to use that same 2% expense ratio, and that's the 1% actively managed funds and the 1% asset under management. We're still rolling with our financial advisor. We're contributing 0 because we're now living off our portfolio. And this rate of return, I put at 4. I'm assuming 8% with our investments, but we're taking 4 out every year. So we expect the portfolio to grow by 4% on average. Now, if you look, the ending value should be 4.15, and that's after losing the $1 million from before, but we only have $2.3 million in our portfolio because that financial advisor, along with the mutual fund's high expense ratios, took off with 1.8 million of our dollars. This is almost up to $3 million in a very realistic scenario. That's how 2% fees add up over the years. Dividends are the better path. I think the 4% rule is a great tool for seeing how you're tracking towards your retirement. I really do. However, as you get closer to retirement, I would highly recommend living on dividends and not selling, so not touching your core portfolio if at all possible. This would be about the 3.5% rule. That is a standard dividend yield for a well-constructed portfolio that also has some solid price appreciation and dividend growth as well. I prefer to use the high-quality dividend ETF SCHD for all of my dividend needs. One aspect of dividend investing that a lot of people don't understand is that dividend stocks will pay their dividends based on the shares that you own. It doesn't matter if your portfolio is up 20% or if it crashed and it's down 50% or if it's about what it used to be. You will get X amount of money per share that you hold, and the shares that you hold will never go down, assuming you don't sell, of course. So as you buy more shares of SCHD and add them to your portfolio, your future dividend payments are only going up based on the shares that you hold. And in addition to that, each share that you hold will increase its payment amount over time. This is known as the dividend growth rate, or the dividend CAGR. CAGR being compound annual growth rate. So yes, on occasion, individual companies will cut their dividends. It happens. Not everyone's going to ultimately be a dividend aristocrat or king over the years. But SCHD holds 100 quality dividend companies. So the odds of all of them cutting their dividends, if that happens, everyone's in big trouble. Let's just put it that way. Let's check out how SCHD has done over the last 10 years. Sometimes it's easier to see these things. So we're going to take the person that needs $50,000 a year to live. We're going to assume they've worked their career, they've invested, they've worked on their portfolio, and they got to that magical 1.25 million that we discussed earlier. So with the 4% rule, where you actually sell and take out 4% of your portfolio, in addition to using some of the dividends each year, you have a very high chance of making it. With this dividend methodology, you have a 100% chance of making it. Okay, fine, no such thing. 99.99% chance of making it. And keep in mind, there are 0 assumptions in this spreadsheet. This is what actually happened over the last 10 years. And final note before jumping over to my screen, this is considering dividends not being reinvested, of course. We are taking these dividends out in retirement to live on them. So we're not trickling a penny of dividends back in to get more shares. For this SCHD example, we'll take the most recent full 10-year stretch. So that's from 1/1/2013 through 12/31/2022. In this scenario, the person retired at the end of 2012 with the $1.25 million portfolio and put it all into SCHD. At the time, that would purchase 42,985 shares. Now you can see, you can ignore 2012, I just need the data. So 2013 is the first year we're living off dividends. It paid 39,000 and then it increased to 45,000 up to almost 50,000. And it kept going up until $110,000 in a single year in 2022. And again, this is without reinvesting any dividends. You only have this many shares the entire time. You can see this column shows the amount that each share will pay you. So this one being just over $1 means you'll have a little more dividends, 45,000, than this 43,000, just to show the math there. And you can see the raise is in this column. This is what you'd compare to inflation or your old salary raises. You know, we're talking double digits most years. That's a pretty healthy raise and you're crushing inflation as far as purchasing power. And in addition to these dividends, which are just strictly based on the shares, they don't necessarily care about the portfolio value. But if you you look over at the end of 22, the non-dividend portion, the price appreciation, has taken your portfolio to $3.3 million of value. And that was $77 a share. Your price return is a touch over $2 million alone. You add those dividends of almost $700K, and that's not counting 2012. I did the math right here. This was just our base year so we could get our first year of growth. So just 2013 through 2022 paid you almost $700,000. Add that to the price and you have $2.7 million of total return. This is why I love the idea of rolling with dividends as opposed to selling off portions of your portfolio. As you can see, the trifecta of dividend yield, dividend growth rate, and price appreciation will make it to where you never have to sell a penny of your portfolio to live an enjoyable life in retirement. And the cherry on the top is that you can live a more extravagant retirement as the dividend growth compounds over the years, and you're leaving a bigger and bigger portfolio for future generations. So you can be the person that starts that chain of generational wealth. And SCHD isn't your only option for a quality dividend ETF. Check out this video right here to see the 5 best dividend ETFs to provide cash flow forever. Thanks for watching, and I'll see you here next Thursday. And sometimes on a Sunday. Bye.